Hello and welcome back. Hello and welcome back to the ROI Club. This is the club where I share my research, take, and due diligence on certain companies. And so today we're going to dive into one of my favorite plays in one of my favorite themes, which is liquefied natural gas and getting it from a place that has it to a place that hasn't and needs it. And so that will require liquefied natural gas carriers. You got two plays, one of which is Cool Company, which will be the subject of today's discussion. So before we get into it, guys, disclaimer, nothing that I say here today is advice. It's simply what I'm doing and how I'm positioning myself. And so nothing is to be construed as investment advice. You need to seek the advice of a qualified financial advisor. That is not me. I am just someone living my life. And so please do take responsibility for your own decisions. Having said that, this video is sponsored by the Options Mavericks. And if you're looking for a way to copy my homework, essentially, you do have access to the Crassus Investments portfolio that's on eToro. This is actually outdated. Year to date, we're up over 30%. And I follow a deep value / income strategy. Okay, let's get straight into it. Enough of me talking about my performance. Cool Company is such an interesting play. Full credit to Chapman Scarborough. You can see my two discussions with him. Link will be in the description. In one of those, we do discuss Cool Company and our respective valuation, and then we compare notes. So it's we've received great feedback for that, and it seems really cool. Make sure you guys check it out when you get the chance. So Cool Company, they engage buy and own a fleet of LNG carriers, and they support the energy industry via collecting natural gas in its liquefied form and then transporting it to wherever it needs to go. So they now have, I believe, 13 vehicles or 13 vessels, better to say. They also are involved in floating storage and regas units on behalf of third parties. So this is a simplified breakdown of the company's structure. With the energy crisis continuing to loom, and with us seeing these commodity outbreaks really moving recently, you've seen uranium go through the roof, oil's back up over $90 a barrel. A European winter coming into Northern Hemisphere winter, it's highly likely we're going to see a run up in gas, and so gas needs to be liquefied and get somewhere. This is one way that that you do it. That's how you store gas. And I think also coal will likely to follow that. Given last year's huge spike in European gas futures, TTF, if you're following those markets, you just saw what happens now. Since then, nothing has changed for the better in terms of either pipelining gas or storing gas in Europe. And so they are really going to need it over the next few years. And that gas will need to come basically from the US. Canada can't seem to get its act together, and neither can we down here in Australia. So you'll have to freeze that gas, or liquefy that gas, better to say, and then put it on a carrier, a specified carrier. You've got one of two options, and Cool Company is one of those two options. And I think they're going to do very well for those factors mentioned. So this has been taken from the company's quarterly reports. Where the opportunity is, if you look at the global LNG market as of 2023, that's around 400 MTPA. Okay. Now, 500 megatons worth of coal, they're targeting to be replaced with natural gas. Okay. Because it's much cleaner than coal, more efficient energy return on energy investment, and all the rest of it. So if you had that energy equivalent in LNG, that equates to around 200 MTPA. In other words, the management of this particular company, or the IEA, which is where this has been sourced, they expect the demand for LNG to rise by 50% over the next few years, which is super, super interesting when you consider that there really just aren't that many ways of playing it from a carrier point of view. So Dutch TTF futures here, you can see they went through the roof on the back of the European winter last year, thanks to, well, basically a complete cessation of all diplomatic ties with Russia, which was where they had their pipeline supply. And so you can see, you can see that that's simply petered off since then. However, as far as I can tell, the Europeans will still need a hell of a lot of gas, and they don't have the pipeline. So the demand for LNG carriers is going to significantly be on the rise as a result of that. And that's just talking about one market alone, let alone replacing this Chinese demand here, 500 megatons worth of coal, which is the equivalent, as we said, of 200 MTPA of LNG. Let's take a look. The company, one pager at time of recording, the price $13.80. They've had a wonderful run up recently. I really like the way this management has been using their cash. So this company has a substantial coverage of their net debt already booked out. In other words, think of it this way: they've pre-sold enough to more than cover their debt. Okay, in terms of their charters, which is fantastic. In addition to which, they still have a decent amount of exposure to spot price, meaning instead of being an agreed day rate, they have access to the spot market, and so they'll kind of charter out on a on-demand basis. And if this supply demand situation that I just mentioned really does come to fruition, obviously those rates are going to skyrocket up, and that's just more free cash to the bottom line of this company. They've done, as far as I can tell, a very good job in terms of stewarding the funds that they've earned. They've really got a very low amount of debt as it is anyway, or low net debt. If you see here, their net income versus what they do with that in terms of capex, where it comes from, and what they do with it. So yeah, I like how they do this. They've been able to pay out about 94%, there it is, of their net income in the second quarter of this year as a dividend. Okay, so that's really, really nice. Treating the shareholders as the owners of the business, which is how it should be done. So if you take a look at their dividends, they've been very steady over the last few quarters, 40 cents, 41 cents, 41 cents again. Yeah, they have stated that they're going to pay out a huge amount of that free cash flow as a dividend. So we should expect to see a solid shareholder return program continue. If you take a look at their cash, okay, on the cash flow statement, they've been able to add a hell of a lot of cash, which includes some buybacks. So they bought back quite a lot of stock. They paid out dividends, and there's nothing else you could really ask in terms of management. They've done a great job. There was a question as to how sustainable that dividend would be, and I've taken a little excerpt from the transcript here. You have to understand that they're getting 2 new builds coming online very shortly, and they are going to debt finance this. So in terms of their cash coverage for the dividend, that does not appear to be a factor at all. They should be able to continue paying exactly the same amount as a ratio of their dividend, without having to and pay for their new ships without having to affect the dividend at all. So here we've got where their debt is structured, they'll be able to either pay down or roll forward quite a lot of that. Most of their debt, see, 73% is fixed, so they are not at the mercy of interest rates by any means. Okay, here's the management. We don't have a huge amount of, we don't have any one main owner. They've got a lot of institutional investment here already. So that could work one of two ways. Either if we get more of a risk on environment, people willing to allocate more towards these passive investment funds like Fidelity and BlackRock, etc., you'll see that come into the space, and they'll have a flywheel effect bidding up the stock. If we see a risk off environment and people get a bit scared and they want to redeem these funds that you can see here, you'll have forced selling of this particular equity, and I'll be on the other side buying up a declining stock price. Alrighty, so back of the envelope valuation. the EBITDA, the earnings, and the free cash flow as listed. Now, the free cash flow has an asterisk next to it because one analyst has the company actually being cash flow negative for the end of, for next year, and then making up for that in the year after. I don't know why. When I just showed you the backlog from the quarterly presentation is more than enough to sustain operations. But anyway, EBITDA, earnings, and free cash, and then these multiples that I've listed here. Obviously, you can agree or disagree with those multiples. I have they look aggressive, but they're not really. I don't consider them aggressive in a standard market of yesteryear. 8 times earnings for the S&P. Well, I'd rather be paying 8 times earnings for a company that's generating free cash and spitting out 94% of that as net income, paying me double-digit dividend yields. Yeah. So I think that an 8 times multiple is justified. This earnings here, they've almost earned that already this year. Okay, so for the latter half, I could easily see this being a lot higher. Then same deal with the free cash. Obviously, a 10% free cash flow yield is it will provide you with a real return. It's well above a yield offered by any of the bigger tech stocks. I know that's not really comparative, but it's well above a risk-free rate. So I've done 2 different valuations. One using my own kind of estimations without making not assuming that they go cash flow negative next year, and one just taking the analysts' estimates at face value. In either case, the price targets are suggesting at 1.8 to 2.5 times return on investment. If you believe all this, and if that plays out, and from the current share price, yeah, the company's starting to gain some interest. So from a low of just under 1050, we're now up at 1370, and it appears to be quite a bit of momentum in the sector. Recently, this week, shipping stocks, or carriers, better to say, for crude oil, product oil, and LNG have been absolutely on a mission. Right at the time when I've been writing about it, so I got the timing right for once. But yeah, things are going really well. If you're interested in the options plays on a lot of these carriers, check out the Maverick Life. Link will be in the description. Otherwise, by all means, take care. And I look forward to catching you in another video shortly.